Thanks everyone for joining us today. This is the July CALUCA Town Hall, and today's topic is selling your urgent care or selling your medical practice. And we have two representatives from the NYBB Group, Lou Della Prida and John Byrne. And Lou and John, I'm going to let you introduce yourselves. And what we'll do today is after your presentation, at the end of it, I'll come back on and we'll answer any questions that are in the chat and get going. Okay.
Excellent.
All right.
Thank you so much. Thank you so much, Dr. Pricey, and good afternoon, everyone. My name is Lou Della Prida. I'm a managing partner at the NYBB Group. I'm a certified M&A advisor, and I specialize in the healthcare industry. Prior to joining my firm, I was the former chief operating officer of a multi-specialty group over here on Long Island, New York, that focused on urgent care and primary care. So I have some experience operating 7 days a week and getting everyone to call me at 4 o'clock in the morning. I also have served on the UCA Education Committee, where I've taught a couple of classes on M&A, in particular during several UCA conferences for the newly designated designation program. I was also recently nominated to run for the UCA Board of Directors, and I'm looking forward to spending my birthday in October at New Orleans in the middle of October. And I'd like to introduce my colleague, John Byrne.
Hi, everyone. My name is John Byrne, and I'm a certified merger and acquisition advisor with the NYBB Group. Within the group, I specialize in healthcare and human services related companies. My original background was I was a hospital executive in New York City. Many of the health systems I worked for did operate urgent care centers, and I was responsible for the operations and was even involved in the construction of new urgent care centers. I've also been a healthcare consultant, principally and revenue cycle. I've worked for some healthcare startups, and for established companies, I've done some new business development work.
Thank you so much, John. So as Dr. Pricey mentioned, we welcome questions. So please take an opportunity to submit them via the chat. If we have an opportunity to answer them in the actual segment that we happen to be talking about, we will. In other words, if it's a short question, and if it's a little longer, we'll defer it to the end of the presentation. And if for some reason we can't address it at that point, we have our contact information at the end, and you're more than willing to contact us and we can help walk you through it.
And excuse me, Lou, we already do have one question asking us if we can address how to sell a solo practice, EBITDA, multiples, etc.
We can, and we'll address that, in due time as the slides move, in future slides. Okay, so before we start, we really wanted to take a poll of the audience. And John, I'm really looking to you to help me with this because I'm maximized on my screen and I really can't see who's submitting questions via the chat.
Sure.
But if you don't mind, if you could let us know, how many locations do you operate? Are you a buyer or are you a seller? And where are you situated? Are you in an urban center, a suburban, rural, or a combination of those? So take this opportunity, please, to tell us via the chat. So what I'm really trying to figure out is whether or not you're a large practice and whether you're a buyer or a seller. So most of the practices that we represent are physician-owned, and the practice is pretty much their largest asset. When you look at any business owner, usually their business is their largest asset, besides maybe their 401k. And in the case of a physician practice, it not only is their largest asset, but it's their livelihood. It's what they do for a living. It's what they love to do. It's what they find the most rewarding. The problem oftentimes is that a seller, especially a small seller, is selling, is usually less experienced when it comes to M&A than the buyer that they're selling to. They have less resources, they have less capital, and they often have less access to advisors. In fact, if you're running your own urgent care center, you probably find that you're wearing multiple hats, right? You're the one that sees the patients, you're the one that pays the bills, changes the light bulbs when they go out, deals with the staff, and so on and so forth. And then the question is, how do you level the playing field against these buyers that are much more sophisticated than you are and that are much better prepared and capitalized to do a transaction. In fact, for many of you, if you're thinking of selling, this is probably the first and only time you're going to sell something very significant for you, other than maybe your house, but yet you're selling to a group that probably has acquired 25, 50, maybe 100 different practices. And so you're already at a bit of a disadvantage. And so how do you level that playing field? And the answer to that is, what nobody likes to hear, is that you start to prepare. So over the course of the next hour or so, we'd like to help you answer 5 questions or learn 5 different things. The first is, how do you prepare to sell your practice in 5 easy steps? How do you determine the characteristics of the different buyers of urgent care centers? You obviously know that if you're selling, you have to know who it is that is buying, but you all on some level know who's buying. They've all approached you over the last couple of years. So what you really need to figure out is what makes these buyers tick, and are you the right candidate for them, and are they the right candidate for you? And then also there's a process to M&A. In fact, if you hired an M&A advisor, really what you're looking to do is to hire someone who casts a broad net and brings the greatest number of buyers for you. But at the end of the day, that creates a disciplined process that brings those buyers to you. And then you need to familiarize yourself with the common transaction terms, because it's not just what you've been offered from a price standpoint. Sometimes you can get a buyer who actually offers you less than another buyer, but their terms are just so much more favorable and you get along with them so much better that you're actually better off dealing with them. And then lastly, we'll give you a couple of tips on how to negotiate like a pro. When you look at the 5 steps that are there, we're going to primarily spend a decent amount of time in the first 3 steps. And then the 4th step really deals a lot with the attorneys. And the last one is pretty much a summary. So we're going to spend the most time with the first 3 steps, but we're glad to answer any questions on any of those steps. So the very first objective is to prepare to sell in 5 easy steps. So I'm going to pass it over to my colleague, John Byrne, who will walk you through some of that, and I will join him as well in some of those steps.
Thanks, Lou. So the goal of our preparation methodology is to level the playing field between the seller, who this may be the first time they've sold a business, and the experienced buyer. Preparation is the key. Preparation is the end all and be all of being able to successfully negotiate with an experienced buyer. And our 5 steps are patterned after a physician practice. So the steps that we take you through include scheduling a checkup. And the checkup is really speaks to your strategy. What is it that you want to achieve? Okay. All providers value the importance of good chart documentation. Good documents are vital to the sale process. Performing diagnostics on your business. How well is it running? Recruiting a team. And here the team can include people like attorneys, accountants, sometimes financial planners or exit planners, and other types of advisors that might be needed. And then what we want to do is to show you how to get started on that plan. Lou?
You're up, John, actually. This is step 1.
Oh, I apologize. Okay. Good physicians use checkups as a way to determine the general health of their patients. In the same way, good business owners use checkups to determine the health status of their practice and of their business. This step requires understanding the health of your business and giving serious thought to your end goals. Take a look at this slide for some of the end goals that you need to be considering. Do you want to retire outright, or are you intending to work after selling your business? Do you want to become part of a large hospital system? And in this presentation, we'll go into the pluses and minuses of being part of a large hospital system. Do you see your practice as part of a large group? Many people value the resources that a large group can bring to a practice, but other business owners have resolved that they never really want to work for anyone else. And they don't like they see it as confining to work for someone else. But what it's all going to come down to is how long are you willing to continue to practice medicine? And this is something you're going to have to ask yourself honestly, and this is going to factor into your plan. When we talk about getting ready, I mentioned documents. So financial documents, you want to have 3 to 5 years. The more, the better. If you have 5 years, get 5 years. Okay, don't settle just for 3. At the same time, you need to have some familiarity with these documents. You don't need to be able to speak to your financial statements, but you need to know where they are, how to get a hold of them. You need to be able to represent the owner's true compensation. Buyers, will be very interested in this. On human resources, you're going to want to be able to say, who are your key employees? What are your human resource issues? Who are the providers in the practice that are vital to its running? Buyers will also be very interested in the employee benefit package you have. Any documents related to the operation of your business are important to the buyer, okay? The buyer will be looking for legal agreements and other legal papers such as articles of incorporation, your payer contracts, and other contracts that you have with individuals or with companies or suppliers. And again, you don't need to be able to speak to those early in the early going, but you need to make sure you have them. You need to be sure that you can access them.
Excellent. Thank you, John. And before I move on to the next slide, one question we're often asked is with regard to owner compensation, especially when a lot of practices sell at a multiple of their net cash flow. And one concern that practice owners have is that, if you look at the income that they report on their tax return, it's usually either 0 or very close to 0, especially for the smaller practices. And so the key thing here is that when you look at owner compensation, we're talking about not what you pay yourself in the form of salary, bonuses, and any benefits. So you might have a health insurance plan, you might have a 401k plan or other retirement plan. You might have some employees or family members that are on your payroll. Those are very important. And then we didn't list it here, but as well, quite often when urgent care centers are, in the building phase, you're spending a lot of money building out your location. And these are one-time charges that are not likely to recur. And so any M&A advisor, is going to be very interested in those one-time charges because you can adjust those to come up with the true net cash flow. And we'll talk a little bit about net cash flow as we move on. So the next step in the process is to perform diagnostic steps, right? So what do you do when a patient presents to your practice with multiple issues, in need of attention? You probably arrange for a consult with trusted medical specialists. And in the same vein, if you wind up selling your practice, you want to assemble a transition team. Here we go. Sorry, I'm still getting the hang of this Zoom thing, right? So when you look in the early stages, a lot of the advisors that you're going to be working with are really going to be more your personal advisor. So the first one is the M&A advisor, since that's what we are. That's why we mention it. And we'll walk you through and educate you what the process is like, and really try to drill down and get a sense of what your practice is worth and how to position your practice for the market, right? But you already have a lot of existing advisors that you've probably been working with for a number of years, and you're going to want to recruit them very early on. So one obvious example is your accountant, who probably not only helps you with tax matters, but also helps you with your financial statements. And one thing that I think is often lost in these transactions is that, I could offer you $5 million for your practice, but how much of that are you actually keeping, net of the different fees that are incurred and net of the different taxes and so on that you're actually paying? And so your accountant is often a very key advisor to help you answer some of those questions. And it's probably someone that you've been working with for decades. The attorney, we've done these deals. Every attorney that we've spoken with, they wish that they were involved in the early stages of the process. And unfortunately, sellers don't often do that. They usually bring them in when it's a little bit too late. So I encourage you to use them early on. But if you actually have an attorney that you've been dealing with throughout the years, pick their brain a little bit about what it takes to get you to market. And financial advisor. I know I worked as a financial advisor for a number of years, and you probably all have a financial advisor. They're really, really good at understanding not only your personal financial situation, but your business situation. And so that's always a great resource to talk to in the early stages. And then obviously there are other advisors such as exit planners and IT and so forth, and we'll talk about those later on in the presentation. Where am I at? Step 5 here. Okay, so you've taken a history, you've done a review of systems, and you've ordered some needed tests, right? So you have reached the assessment and planning stage with many of you are so familiar with, right? So now is the time to review your goals and decide how you want to proceed. Do you want to sell now, or do you want to hold off? Do you want to buy? Do you want to merge? Really, the whole goal of these last 5 steps is to help you figure that out, because only you can answer that for yourself, right? If you're not ready to go to market, no one can twist your arm, no one can get you to go to market. But if you are, then there are a whole bunch of things that you need to do in order to prepare for that. And so you need to really assess that. Am I ready to sell? Can I live on the amount that I'm likely to get on an after-tax basis? Can I work for the people that are likely to buy me if they decide to keep me on board? These are the kinds of things that you need to answer for yourself. But no matter what you do, and especially if you decide that you want to sell your practice, you should stay focused on running your practice. One of the biggest pet peeves of mine is that I often get called by practices that it's usually somebody in the late stages of their practice where they've been operating for 30, 40 years, and they decided that they just can't take it anymore for all of the reasons that anyone who practices in the healthcare world understands, right? You're getting beat up on a daily basis. And so what do? They cut back. If they used to work 7 days a week, they work 5, they work 4, they work 3, they go to part-time, and then they actually ask us to sell their practice, and that's just a very difficult proposition. So if you're looking to sell the practice, you need to stay focused on running it. You need to take care of your patients, because you're going to ultimately transition those patients to a new practice, and you need to take care of your employees, because no matter how much you try to hide the fact that you're going to market and selling, some employees are going to hear about it, and they're all going to be concerned about what that means for them. And then lastly, you need to know the benefits and challenges, right? So you need to find ways to improve it. You need to recognize areas that need improvement. When you look at, for instance, one of the things that you'll be asked for is you'll be asked for your financials, and think about it, right? If you put yourself in the shoes of a buyer, would you rather buy a practice that their earnings and revenue were going this way, or one that was going that way, right? Increasing every year little by little, no matter how little, or decreasing little by little. And that's especially important in the pandemic, right? Because there have been very few businesses out there in this country that have not had some kind of dip or some kind of hit to their earnings. The only ones that really haven't have been the ones that have been essential in one way, shape, or form, during the pandemic. Even urgent care centers, most of our clients, especially in 2020 in the early stages, some of them were shut down for a few months. Some of them were trying to figure out, how do I operate in a way that is safe for me and safe for my staff? And so, that inevitably led to a dip in earnings. And so how do you compensate for that? And more importantly, how do you show a trajectory of slightly increasing earnings? So let that pause there. So the next objective really is, now you figured out, what is it that I need to do to get ready to sell? And then now the question is, well, who is actually buying? And, one of my partners, that's the question he always wants to know. No matter what industry, we get approached by, sellers in different industries, some of which we don't represent. And he always wants to know who's the ultimate buyer. So in your world, you actually know who the ultimate buyer is. And chances are the reason that you know that is because they've been approaching you for years. And they're listed right there, right? So it's the hospital systems, it's the big urgent care centers, it's private equity groups, which we'll talk about in a minute, increasingly health insurance companies, and then other physician groups. So hospitals, right? So hospitals are the first major type of buyer. I'm trying to make sure that I'm in the right spot here, forgive me. And so hospitals offer the following benefits, right? If you actually go online and you Google how to sell my urgent care, I guarantee you that one of the first to top 3 searches is going to be probably from a large group that is helping you address your administrative burdens. In fact, when I worked as a COO, and my job was to go out there and approach different urgent care centers. Whenever I would approach them and I would ask them why they wanted to sell, they would all tell me that they loved the practice of medicine, but that they hated the business of medicine. And thankfully, we love the business of medicine. But if you really step back and think about that, that's really a bad answer, right? Like, you're selling your practice, which is really a business, to somebody who quite often the person you're going to meet is going to be an MBA, such as myself. It's a business person, it's not a clinician. And you're telling them that you don't like to basically run your business, but you're selling them your business. At the same time, though, they do understand that, administratively, the last few years and maybe even decades have really not been kind to those in the healthcare world. And so everyone knows that you need administrative relief, and hospitals are in a great position to be able to provide that. One is in the form of staffing. You operate 7 days a week. And so anyone that has more staff than you do that can help you, field that call at 4 o'clock in the morning on a Saturday, I think is great. But also in the form of back office. They have accountants, they have attorneys, they have bookkeepers, different people who can help you with the different things that right now you probably handle yourself. They also provide an important measure of financial stability. They usually have a better fee schedule than you do, simply by virtue of the fact that they're so much bigger. They actually pay you a salary, right? How do you pay yourself now? Usually you're the last person to get paid, right? You pay all of your staff. Well, if you work for a hospital system or a bigger group, they're actually paying you a salary. And then they also have economies of scale, which you can really see when it comes to some of the purchasing decisions that you make. So if you have to purchase vaccines or supplies for your office, clearly a hospital that is way bigger than you, to the tune of like millions of dollars, is probably going to get better rates when it comes to, to those expenses. They often can spend a lot more when it comes to branding and marketing, and they're probably better known in the community than some of the smaller urgent care centers. The con, meanwhile, is that they're highly regulated. I remember there was a period in the early stages of the, urgent care consolidation and physician practice consolidation, where I would see a lot of physicians would sell to the hospitals, and they really would not be happy. They would complain. It was such a major paradigm shift for them, and it took a little while to get used to the fact that they were working for a hospital. I think, thankfully, to some extent throughout the years, I think the hospitals have improved in that regard, and I think the physicians have had a better understanding of what it's like to work for them. And so some of that has been ameliorated, but I don't think that it's completely been eliminated, simply by virtue of the fact that, again, those are more highly regulated entities. And so that's a problem that you need to deal with. So why are hospitals buying, right? You're probably all very familiar with this, right? So the major reason is that they're trying to meet consumer demand. And you also represent, a form of new revenue streams for them. In the early stages of the urgent care world, the urgent care centers would basically set up shop right across the street from the emergency medicine department. And they actually not only took visits from the ED group, which may or may not have been owned by the hospital, but then over time, they also started to impact other other service lines, if you will, within the hospital. And then so that this allows them to take market share, bring new patients to the network, and expand their footprint, both from a size and a services perspective. Equally important, it also allows them to decrease their ER utilization. Most of you probably came from the ED world, and so you know what that world is like. And then the ones that didn't actually came from the primary care world. And you know that there's been a shortage for a number of years when it comes to primary care physicians. And so that's something that urgent care centers have done a great job of helping with. In the last couple of years, again, as most of you know, these primary care physicians have actually started to wake up. And so little by little, they're starting to actually represent some competition for you. So hopefully we'll talk about that a little bit later on. John?
Sure. The next type of buyer are the large urgent care centers. Some of the benefits are somewhat similar to the benefits of joining a hospital. The large urgent care centers are able to provide professional management. They have accounting, billing, and collections departments that can provide those services. They can provide providers with clinical care guidelines. They can provide operational support. They usually will provide an electronic medical record and a variety of IT applications and services. They're in a better position to provide modern medical equipment and facilities. They have compliance standards, which are helpful for many, many reasons. And they have training programs, particularly important for employees. Most of the large urgent care centers also have established programs for marketing, communication, and they're very experienced at branding urgent care. So that's all to the good. Okay, the reasons why they're buying, again, some of these mirror some of the reasons why hospitals are buying. The one difference is the urgent care centers probably prioritize profitability higher than the hospitals do. Hospitals have many service lines. They don't have the same profitability expectation on every service line. Some service lines might be provided for community benefit. Some are provided to bring patients into the system. But the large urgent care centers can help the centers they acquire to build market share, achieve it. They are looking to achieve additional economies of scale. And they're usually looking to buy regional groups of 1 to 10 locations. They're looking for groups that have solid management, that have good locations, and very important, a good payer mix. So they are paying attention to profitability, and they're also looking for good service offerings. They want to acquire urgent care centers that have good services.
Excellent. So before I head on to the next group, which are private equity groups, I saw a question here in the chat. Thank you so much, by the way, Sunil, for submitting it. And the question is it common to ask for tax statements or bank statements? So what happens is that in the early stages, we're going to talk about this a little bit as you prepare for sale. They're going to ask you for either, we are going to ask you for both tax statements and financial statements if you have them, right? And you probably know that there's a bit of a difference between the two, right? Because one is aimed at maximizing, all of the deductions that you can, and the other one is probably presented either on a cash or accrual basis, but is really just presenting, a picture from on a pre-tax basis, right? And so when you prepare the book, they're definitely going to ask you about the tax statements. The bank statements we're usually not going to give to someone until they've actually made you an offer and they're in due diligence and they're actually confirming what you presented to them. And I'll talk about that in the next couple of minutes. So the next major group are private equity groups, right? And so let me make sure I have it here. So when you look at a private equity group, if you look at a lot of the large consolidators in the space, there came a time when they probably operated 1 or 2 locations. They maybe expanded a little bit, and then eventually it went out and they brought on outside investors. And usually that outside investor was either a private equity group or a family office. And what they basically are a form of financial sponsor. So they're investors that really have a lot of expertise and have the capital to provide you from a financial standpoint, and are usually partnering with someone who has operational experience to help grow the practice. The typical private equity group has a time horizon of somewhere between 5 to 7 years. And usually they're almost kind of like required, and I put that in quotation marks, to sell you within that time period, because the way that they operate is that they raise money from general partners, if you will, and then they promise those general partners a very decent rate of return, usually in the 40 to 50% rate. So they'll go out and they'll raise money from pension funds, insurance funds, high net worth individuals, big family offices such as, Bill Gates and, the billionaires of this world, and they'll promise them a return on investment. And they were very, very active in the early stages of urgent care consolidation. And part of the reason for that was that the industry was highly fragmented. And what a fragmented industry is basically is an industry where no one major player accounts for more than a certain percentage of the industry. And if you look at that, I think everyone here on this call knows that the last couple of years, the industry has consolidated in a major way. Hospitals have bought up a significant number of practices. Big groups have bought up a significant number of practices. But if you actually do some research on urgent care centers, you'll see that there's no one practice that owns 5% of the market. And so what that means is that it's still a highly fragmented market. And what that does for private equity groups is it allows them to buy these groups for a low amount and basically sell them for a much higher amount, right? Usually they benefit you in the form of, similar to the hospital, because they're bigger groups, they usually have greater employee benefits. They have much better contracting rates than you probably do as an individual provider. And they also have the same economies of scale when it comes to purchasing. They usually offer a flexible career path as well. It's slightly different from a hospital model, as I think many of you know. It's not hospital owned. And so they quite often can help you carve a nice little career for yourself. They tend to be physician led. So the private equity groups usually are kind of like behind the scenes, providing the capital and the financial wherewithal. And then the operators are still there really providing the expertise. And so you're still, for the most part, dealing with a physician operator. And they tend to be local and regional, although in the last few years, you're starting to see some groups that have really become major players from a regional standpoint. There really are no national ones, but that probably is going to likely happen over the next couple of years. So, why are they buying? I mentioned the fragmented nature of the industry, right? The rapid growth of urgent care works well with the PE model. Usually they're, so in the old days, right, the private equity groups were really looking to establish a platform company. And what that was that was a company that had a decent enough number of employees, decent enough number of locations, and really could serve as a platform for them to go and acquire. So imagine that, you're operating out of 5 locations and they want to get to 100 locations, and they don't know the first thing about urgent care, right? So you're the basically physician of record. They, you know everything about running an urgent care center, and you have the staff and you can manage that staff. And so they look to you as a platform from which you can grow. And by the way, it's not just the clinical staff, but also even the administrative staff in the locations that you have. So they seek to achieve growth both from a de novo and perspective and by acquisitions. De novo basically means building them from scratch. And I built a couple of locations from scratch. I think you all know how difficult that can be. Quite often, as much as M&A can be a headache, it really allows you to scale in a much more rapid way than to go out and build different locations and spend millions of dollars and go through all of the headaches of getting approvals from the different municipalities and hiring everybody to participate. So they tend to work with centers that have earnings before interest, taxes, depreciation, and amortization of at least $3 million, but they also are interested in add-ons. So if you ever see a platform, you have a private equity backed urgent care center, even if you're smaller, they might be interested, especially if they consolidate a bunch of groups in your location. We listed this group here because it's a major buyer, but it's very rare nowadays to see a private equity group that is still just looking for, an urgent care center to serve as a platform, because it's almost like been like, where have you been the last few years? So most private equity groups are actually really more like hybrids. They're really groups that have been up and running for a number of years. So for instance, here in New York and on Long Island, Dr. Park, who was the president of UCA, he started CityMD, and then he sold that to private equity, and then ultimately wound up selling that to Warburg Pincus, and then from there wound up selling it to Summit. So that's just the natural progression. Usually sell to a bigger group, and bigger and so on. But nevertheless, it's a meaningful group, and whether private equity buys you or not, you need to be on the lookout for the fact that someone who may be buying you may be private equity backed, and so you need to think about, why are you important to them? John?
Sure. So the next group of buyers are insurance companies. And I think many of you are aware that for many years, insurance companies have been very interested in forward integrating from paying for healthcare to also providing healthcare. And that kind of goes back to the days of Henry Kaiser in California 75 years ago. Insurance companies offer sellers the following benefits. One is the financial stability of being part of a large company, okay? And that is something not to sneeze at. That financial stability can be great. The insurance companies also offer economies of scale. And they also offer the ability to learn the reimbursement landscape. There are a lot of very smart people at insurance companies, and the experience of working with them can almost be a graduate seminar in medical reimbursement. Insurance companies are looking to buy centers to control the cost of services and to improve operating efficiencies. And we've seen in the marketplace, both United Healthcare, which is part of Optum, and Anthem are two examples of insurance payers that own urgent care centers. Some of the other buyers that we see, and this is in our other category, and this includes multi-specialty medical groups that want to add or grow an urgent care component. And in a number of markets, we've seen that, where there are many sites for multi-specialty practices, but urgent care is part of their offerings and is well integrated with their other practices. It also includes individual and small groups of physicians that are looking to grow by strategic acquisition of additional sites and additional urgent care businesses. This kind of buyer may be ideal for urgent care centers that at present have low profitability, are relocating physicians that have a short business history, that have not been in business a long time, so they're not going to have a long track record. And they're especially looking for those that will represent additional locations for an existing business. Usually these types of groups, the multi-specialty groups and the small groups, are physician-led, and they also tend to be local. So any transaction is probably going to be in the local area.
So thank you so much, John. We had a couple of other questions here. So one came from an anonymous attendee that said, which buyer type is more common in California? Really, when you look across the country, if you look at the different 5 groups that we just presented, the 2 major ones are the big urgent care groups and the hospitals. In fact, hospitals, for the most part, across the nation, are considered the terminal buyer. And what I mean by that is that eventually the private equity groups are building them because they think that the hospitals are going to be the ones that buy them. I had, it's funny, I had some statistics from the UCA that from 2017, I actually wound up deleting the slide, but I think it was somewhere between 20 and 30% for hospital or joint ventures with hospitals back in 2017. And the big groups were around another 20 to 25%. And with the consolidation that has taken place in the intervening years, those are probably a little higher. And then after those groups, it's really the onesies, twosies, the one-man shops and the smaller groups that basically prevail. The other question that we have here is, how soon should an owner start planning to sell? For example, if someone wants to sell in 5 years, when should they start consulting with a firm like yours? So the answer that the industry gives you is that you should do it now in 5 years. And almost nobody does that, by the way. Almost everybody waits like a few months before. If you could do it a couple of years, even 3 years before, I think that would be helpful. And we're going to talk about it in a couple of minutes, but the key thing really is that one of the things you're going to find is that there are many different ways that you can value a practice, but one of the major ones are really how much are you producing from a revenue standpoint, and more importantly, a net cash flow standpoint. And usually, if that number is not enough, you can't turn the ship around very quickly. And so you might need a little bit of time. And the importance of it is that if you think about it, right, if I told you that, let's say you were making $1 million net, and let's say that at that level, you were at a 4 multiple, so you could sell for $4 million. What if you could sell for one more turn? What if you could sell for 5, right? And so what do you need to do to sell for 5? And it's not just, believe it or not, selling, making more money. It oftentimes might be getting rid of what some of the weaknesses in the business, and that usually takes a little bit of time. And I'll address those in the next couple of minutes. So the next step, I think step 3, and we are at the 40-minute mark. So I'm going to try to zip through these so we can hit the last 3 points here. Is the key in M&A steps, right? So when you look at the steps in the M&A process there, you can give those names whatever you want. In fact, I don't think anybody calls them what I've just called them here. But when you look at the first 3, what those first 3 steps are really doing is are getting you ready to go to market. And what the last three steps are doing is that, okay, you've made a decision to actually sell to somebody and you've agreed to move forward with them. And then they're going through the steps needed in order to vet you and to actually close the transaction with you, right? So for the first 3 steps, you really need to do 3 things. No matter what, we're going to have a lot of slides and there's going to be a lot of information, but you really need to do 3 things, right? The first thing is you need to figure out what your practice is worth and whether that's a number you can live with. You need to figure out how you're going to tell your story. And I'll talk to you about how that is actually done in the industry. And then you need to figure out where and who you're going to tell that story to. And I'm going to talk to you about that as well. So the first step I've deemed here the exploratory phase, right? And what you're really trying to understand is the evaluation and the exit options, right? What type of exit do you want? What's the ideal buyer? What is the timing? The difference, by the way, between this here, what we're talking about here, and what John presented earlier on in the presentation, is that early in the presentation, you were trying to figure out whether you even want to sell or not. By now, you've made a decision you want to sell. And now you need to get ready to sell. And so you need to figure out who you're going to sell to, which of those buyers that we talked about are the ideal buyer, and what's the time frame? Are you ready to sell right now? Do you want to sell in 2 years, 3 years, as the previous questioner asked, right? And so you want to work with professionals to estimate that value. So there are 2 ways that historically that's done. One is through a formal valuation, and the other one is through what is known as calculation of value. The calculation of value is less rigorous and less costly. And usually if you're trying to go to market and you know you're going to go to market, you more often than not do not need the formal valuation. I think some valuation specialists might disagree with me on that, but I find that if you're ready to sell, either one of those 2 analyses will give you a sense of where the range of values are. The important thing to figure out is that even though at the end of the valuation or the calculation of value, they'll give you a sense of where you are, and they'll probably give you an actual number. It's kind of more art than science in some ways. And it really what they're giving you is a range, right? So for example, if you were making 500,000 a year or net cash flow of 500,000 a year, they might maybe you sell that at 3 to 4 multiple. So you can literally do the math, multiply 500 times 3 or 500 times 4, and you know that you're selling for 1.5 or 2 million. And then the question that you really need to ask yourself is like, if I'm on the lower end, what do I need to do to get to the upper end? These broker opinions of value usually they have established methodologies. The 3 most common of which are the asset approach, the market approach, and the income approach. The asset approach really assumes that you're going out of business. So for most of you, that doesn't apply. And then the market approach is really comps, which in the lower middle market and smaller practices are very tough to get, but sometimes they're very informative. So for instance, you could see, a lot of sales of urgent care centers in California, in particular your neck of the woods. You might know what multiple they've been selling for, and so that's helpful. But really what is incredibly helpful is the income approach, which is, how much have you been earning from a net cash flow standpoint, and what multiple should be assigned to that. And there was a question asked about that. We'll try to touch upon that at the end. And then importantly, and this is where planning early really makes sense, is that the idea is to try to enhance your value from a pre-marketing standpoint. For instance, there are certain things that hurt any business, right? One is, imagine a world, and again, this doesn't apply in urgent care usually, but what if you had contracted with certain payers where the panel was closed? In New York here, I was approached by a physical therapy practice that had a lot of contracts with Medicaid carriers, and they had closed their panel. And so if you're buying this and those contracts do not, pass over, then you're buying something that you're not going to be able to service. So that's a key consideration. Another one is really if someone's buying your practice, and this is very relevant in the medical world, if you're the physician, everybody loves you, and they've never seen any of your staff or any of your other clinicians, and you leave, and if they leave, whoever's buying you basically is not really realizing the value that they expected to realize. And so you want to, as much as possible, try to replace yourself. John, let me see, try and enhance value. Give me 1 second, John. So this is all me. So we talked about this, about how 1 year before the sale, you try to enhance the value and complete any management gaps. That especially, you know, if you're a platform company where this becomes very relevant, is you want to have a team in place, a COO, a CFO, someone who actually is running the business besides you, because you're probably also busy practicing. And so you want to make sure that whoever's buying you could utilize this other staff to continue to scale and to grow. And then you want to cut expenses, and you want to improve your operations, document procedures, and then organize your financials. The key idea here, by the way, is again, very early in my career, I used to meet with physicians and I would try to ask them why they wanted to sell. And often they couldn't answer some very simple questions. When you go through this process, one of the things that you really, really want to do is you want to be in command of your business. When somebody, especially somebody like me, an MBA, somebody who doesn't know the first thing about medicine, is sitting there asking you about your practice, you don't want to say your billing company handles that or your office manager handles that. You handle that, because I'm not buying your medical practice, I'm buying your business, and you need to be aware of that. So we talked a little bit about the data gathering stage, assembling the financials, recasting the financials. John talked about how you need to look for your tax returns and your financial statements for the last 3 to 5 years. 3 is great to have. 3 is common to have, I'm sorry. 5 is great to have. And what we're looking to do is we're really looking to make adjustments. Your net cash flow is not just your net income on your tax return. It's not your net income on your P&L statement either, on your profit and loss statement. It really is the result of all of those different add-backs. One of the major ones being the amount that you pay yourself in the form of salary and benefits and any other family members that you have, and then also any one-time items that you may have for your company. But the key here is to not overdo it. And in fact, if you work with us, we won't let you overdo it, because you sometimes run into owners that they'll say, I was dry cleaning something, and I was dry cleaning my uniforms and I want to add that back. The general idea is that if a new owner is going to have that expense or bear that expense when you sell it to them, that's not an add back. An add back is usually something that when you sell the practice, that will not be an expense that they bear in one way, shape, or form. So in the data gathering stage, right? Here's the second point that I was talking about before, where it's like the first step is to figure out what your company's worth. And the second one is to figure out how are you going to tell that story, right? So historically, that's done in 2 ways. If you've ever tried to sell a home and you've gone to an open house, you know that there's usually a one-pager when you get to that home that shows you a picture of the home, what school district it's in, and all the great things about that home. Well, it's the same in the business brokerage world and the M&A world, with the distinction that ours is actually blind. When you're selling your home, you want everybody to know where your home is. When you're selling your business, you don't want anybody to know where your business is. You're not going to put a sign up on your urgent care center that's for sale, because it could help you with respect to with respect to your employees and with your competitors. And so it's got to be on a blind basis. Usually the way that we do it, for instance, if we were representing you in California, we wouldn't say that you were in San Francisco. We might say that you're in Northern California. And we wouldn't say that you're Dr. So-and-so. We would just highlight the features of the practice. And the idea of this teaser is to encourage people to express interest in the company and then go from there. The next step really then is something called the SIM, the Confidential Information Memorandum. And what that tries to do is it really is a 10 to 15 page or 20 page document that tells the full story of your practice. It says who owns it, who are the key employees, how do you market the practice, what does your profitability look like over the last few years, and so on and so forth. The key thing to consider there is that when you work with a firm, they're not just going to give this to anybody. They're usually going to give this to a qualified investor that has completed a non-disclosure agreement, a buyer profile. So in other words, if we're going to tell information about you, we want to know a little bit about them, and so on, right? I think I have like 10 minutes, so I actually have to kind of like move a little bit through this. And then in the marketing phase, so then the next stage is, okay, you figured out what your story is. Now, where are you going to tell that story? In real estate, there's a multiple listing service. In business brokerage, there is no such thing. And so you have to try to figure out what marketing channels are you going to use to cast as broad a net as possible to encourage the greatest number of buyers to actually express interest in you. And so that's done through a combination of both online and offline methods. Some of the online methods are email, direct marketing, and telemarketing. Usually most M&A firms have a proprietary buyer database and different online databases that they subscribe to. And then they also probably have like offline methods that they can use. The idea is to qualify the buyers, to ask them to fill out a non-disclosure agreement, and so on and so forth. And then in the negotiation phase, you're trying to engage with multiple buyers to figure out, what is it that they have to offer you, right? So it's not just the price, but how are they going to buy you? Is it going to be through the form of an asset sale or stock sale? In the former, they're basically buying the assets of your firm. In the latter, they're buying both the assets and the liabilities. And quite often, especially on smaller transactions, attorneys are recommending that they not purchase your liabilities, right? Because that could present a whole bunch of problems. How are they going to pay you? Which I'll talk about in the next segment. Usually in this stage, most buyers will express interest in one of two ways. One is either through an indication of interest, or the other is a letter of interest. Neither one of them really neither one of them is really binding. They're both non-binding. The IOI is a little less formal than the LOI, but the idea is that they've put down on paper, the fact that they want to buy you and at the price and terms that they're willing to buy you at. And then once you go through that, you basically enter the due diligence phase. And since I'm running out of time, the idea behind due diligence is that you told them that you made revenue of X and that you saw so many visits and so on and so forth, right? In due diligence, they're going to want to confirm all of that, both from an accounting standpoint and a legal standpoint. And then increasingly, in more complicated deals, they're looking at IT, they're looking at other aspects of your firm. But from an accounting standpoint, they're going to confirm the quality of the earnings that you've represented. They're going to, in particular, take a look at the add backs that you've presented and make sure that those are some of the common add backs that are acceptable in the industry and that those are accurate. For example, one point of contention is that, maybe you say yourself, you pay yourself $500,000 and then, but they have to replace you, right? So you have to come up with a reasonable replacement salary to replace you. And so usually that's something that needs to be presented. The key point really here in due diligence is that everything you did to get ready to go to market was all about creating value for your firm. It's like you're basically saying to the world, look at how wonderful I am, right? Look at my urgent care center. My patients love me. I'm in wonderful locations. And these are all the great reasons you should buy me. And now somebody actually makes you an offer and they say, okay, wonderful. Let me confirm everything that you told me. And so what happens is that the minute that due diligence comes, the clock starts ticking. And so they're looking at you to say, let me confirm that everything you told me was true, which is a very important thing in a transaction. And then they're also looking for you to be able to provide them the information to be able to prove that it's true. And this is something that really trips up many people. You need to be able to provide, if they ask for financial information, you need to provide it. If they ask for legal information, they need to provide it. And as that last bullet point there says, time kills all deals, and it literally does. There are many buyers that will walk away because you've taken weeks to get them something that they felt that you should have given them in a matter of days. And so if you can't do that, that deal could ultimately wind up tanking. And then the closing phase is the phase where they negotiate the definitive agreements. In medical practices, you usually see a few things. One is there's either an asset purchase agreement or a stock purchase agreement. So that's really, this is what I'm buying. It often is accompanied by an employment agreement. usually whoever's buying you wants you to work with them for a certain period of time. In the best cases, or if that's what you want, it'll be just a few weeks. But usually they want you to work a little bit longer. So they're going to look to you to figure out, what is a proper rate. You're probably paying yourself a rate that was way higher than a rate that somebody, as a non-owner would pay themselves. So they want to know, at what rate will you work for me, given the fact that I've already, I'm acquiring your practice. And then what kind of help can you give me in terms of post-close? The biggest thing, and I know you probably all know this, is I want to keep your patients. So if I'm looking to buy your practice, I hope that you're going to do everything possible to make sure that your patients love me as much as they love you. And by the way, that's not an easy thing, but you definitely play a major role in ensuring that happens. So learning objective 4, I'm down to like 5 minutes. I'm gonna like zip right through this, right? So this part really is very high level, because quite often it's really going to be your attorney that's going to be involved in this, right? So you're going to try to decide what the deal structure is. And the deal structure is important because it impacts the after-tax proceeds of the seller, which again, as a financial advisor, I would argue there's nothing more important than that, right? It really is what goes in your pocket, not what somebody offered you. And then again, those are 3 different approaches that somebody could take when it comes to buying you. So when it comes to purchase consideration, you're going to be offered some portion in cash, usually in the form of down payment, and otherwise, if sometimes one of the bigger buyers might issue buyer stock, there may be a seller note. You don't really usually see this as often in seller note, but it's something that's common to the business brokerage world. Earnouts, that is very common, and what that is that a contingent deferred payment where somebody is saying, look, I'll pay you X, but you have to do Y, usually in the form of revenue. That's usually used as a way of bridging the value gap. Purchase price adjustments, right? Once you've agreed on a price, it's not, you have to take into account the fact that if I paid you, let's say you want a $5 million for your practice, and I give you that $5 million, well, if most of these deals are done on a debt-free and cash-free basis, and you keep your cash and you pay off the debt, then what is left for me to start operating? On day one, I have to start operating. I have to start paying the clinicians and the staff, but yet I have no money to do that. And so I need some working capital in the form of, in order to basically be able to do that. And the key thing here is that some of those working capital adjustments can be either done on a downward only basis or both ways. They can be done at closing, they can be done post-closing. There's this thing called as reps and warranties, and they're usually meant to cover areas of potential liability for the buyer. And they serve the functions of aiding with due diligence, providing a certain certainty of close, adjustments for purchase price adjustments, and qualifier for add backs. And then there's some closing conditions that you can either close and sign at the same time. You can do it pre-close, or you can exchange funds later. And then I would expect that almost all of you, if I'm buying your practice, I'm probably going to want to have either a non-compete or non-solicitation agreement, because if you can go down the block and compete with me, that would represent a major risk to me. And there are other post-closing documents. And then lastly, I may require a certain level of indemnification on your part. Oops, sorry guys. Okay, so John.
Okay, so through this process you've prepared, you've learned a lot about the different kinds of buyers. You've learned about the different phases of a transaction, and you've learned the key terms. Hopefully during each of these, you've managed your negotiations like a professional, okay? But in terms of managing your negotiations like a professional, a few things to keep in mind. First, terms matter. It's not just about the purchase price. Purchase price is very important, but terms, and I've seen this happen to friends of mine who've sold urgent cares, sometimes it can be the terms that kill you. In your negotiations, you need to know when to yield strategically. If you're giving up something to your buyer, understand what you're giving up and what you're getting back. know your adversary, and kind of understand where he's coming from. And our firm has recently published on LinkedIn a couple of papers on this recently on getting to know your buyer. Be prepared, and there's no substitute for great preparation, okay? And then consider, depending on the circumstance, making the first offer, telling the buyer what price it is that you would accept. And if it doesn't look right, it's okay to walk away from it.
Excellent. Excellent. Thank you so much, John. And I see Dr. Pricey, you're back. There's one more question. If you don't mind, I can enter it in 2 seconds
Go ahead.
and
Yep.
pass it off to you.
Yep.
So the question is will your group market the urgent care center to potential buyers as well? That is totally why you hire a business broker or an M&A advisor. And usually, once you've calculated the value, once you've told the story, and once you figured out where you're going to tell it, one of the major things that you're doing is really coming up with a buyer list. And that buyer list, I didn't mention it before, there are really 2 types of buyers. They're either strategics, which are companies that are in your industry, which is either a hospital or another physician group, or they're like they're the financial sponsors. We have access to both of them. So one of the things that a good M&A advisor would do is they would look at strategic buyers within your catchment area, in other words, other urgent care centers, and they would find a way to contact them. And then they would also look at buyers either in your catchment area or in your region, or buyers that are looking to expand into California, and contact them as well.
Thanks, Lou and John. Really appreciate your time today, and it was really interesting presentation. I want to let everybody else that's still on the Zoom here that we have nominations are now being accepted for the 3 open seats on the CALUCA board. You can go to our website and apply. And remember to register for the conference in September. It's here in Monterey on September 17th or 18th and 19th. And we'll be sending regular updates about the fall conference through the CALUCA listserv. So thank you, and thank both of you for presenting today.
Thank you so much.
Thank you. It's great being here.
Take care.
Take care.